Kotak single invest advantage plan. Will this single premium policy bring any advantage to your investment portfolio? Will this single premium policy help you achieve your financial goals faster? Let us evaluate and explore. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions. Before analyzing and evaluating this particular policy, let us first understand the key features and benefits of this policy. Kotak Single Invest Advantage is a unit-linked insurance plan. That means the money collected from you as premium, right, over and above the life cover charges and other charges, actual investment money will go into units. When I say units, it can be money market units, it can be stock market units also. So there can be volatility, there can be ups and downs. This particular unit linked insurance policy will go through market risk. One unique thing about this particular policy is it is a single premium policy. You pay one lump sum premium, one time payment. There is no regular premium, there is no limited year payment premium. All those variants are not available. Only single premium policy is available in this particular version. There are three investment strategies based on which the fund will be allocated to different options. That is self-managed strategy. Couple of fund options will be given to you. You yourself can choose how much allocation to be given to each fund. You can choose. It is self-managed strategy. Age-based strategy is the another strategy. In this strategy, you can you will be allowed to invest in funds in a predetermined asset allocation combination. If you are young, then like a combination of investing more in equity, less in fixed income will be given. If you are closer to your retirement, close to 60, then comparatively less in equity, more in fixed income. That kind of allocation in fund options will be given to you. Also, systematic switching strategy. This is similar to the systematic transfer plan available. You can invest in some safe assets and it can be transferred to equity over a period of time. That way is also you can do it. There are three strategies. You can pick and choose any strategy which suits to you and invest. It is completely your choice. Like any other ULIP, this particular ULIP, though it is a single premium policy, even here there are high charges, right? For premium allocation, 2 to 3% is given as charges. Then fund management charges up to 1.35%. Switching charges, over and above 12 switches, like they charge you. Then for partial withdrawal, there are charges. If you want to discontinue, depends upon the year, like they'll be charging you. And life cover charges is also there. Out of these 6 charges given in the screen, right, only mortality charges and fund management charges are real justifiable charges from the investor's point of view. Rest of the charges are overloaded charges for investors. So these charges are not really justifiable from the insurance company. These are all additional costs peculiar to insurance product. These costs like premium allocation charges, switching charges, or like discontinuance charges are all not available in like other investment options like mutual funds. And what is the benefit you will get by investing this policy? That we have to understand. First, we will understand the benefits, list down the benefits. Then let us compare the same benefits with alternative products so that we will get clarity where this particular policy stands. Right? There are two types of benefits given by this particular policy. The first one is death benefit. In case of unfortunate death of the policy holder, how much death claim the insurance company will pay to the nominee of the policyholder. Insurance company in such an unfortunate situation, they will make three calculations, three valuations. Out of those three values, whichever is higher, that will be settled to the nominee as death claim. What are all those three values? First one, basic sum assured. Second, fund value as on date of death claim. Then number three, 105% of the premiums paid. Out of these three values, whichever is higher, that will be given to the nominee as the death claim. Right? So you have understood all the three values and all the details about the death benefit. You are very clear now. Now is the time to understand the maturity benefits. Before going to maturity benefits, let us discuss some advantages of this policy and disadvantages of this policy. Right? This particular policy is an investment cum insurance policy. Based on your risk profile investment objective, you can choose, you have got an option to choose investment strategy. You can move money from like one fund option to other fund option, you can do. All these things are possible, right? In Kotak single invest advantage policy, what are all the disadvantages? There is a lock-in period of 5 years. Before 5 years, whatever the money invested cannot be withdrawn. Right? So there is a definite lock-in period of 5 years. We have already seen that there are huge charges associated to this particular policy. The charges are much higher compared to mutual funds or PPF or other investment options in the market. And because it's a 5-year policy, people may forget to track the performance and move from one fund option to the other fund option. It is not possible for the investors to do it. And investment risk, market volatility, ups and downs should be borne by the life insured, the policy holder. Whereas in the endowment money back additional plans, these kind of investment risk is not there for the policy holder. Okay, we have seen the benefits, we have seen advantages and disadvantages. Now is the time to look at the maturity benefit, because when you are investing in this policy, what is the maturity value you get, how much investment returns you get, that plays a crucial role in deciding any investment. I'm giving me money now, when I get back, will I get good return? Because I'm taking a risk, will I get a risk premium return? Will I be able to beat inflation? Will I be compensated for long-term returns? All these questions we have to get an answer. So let us take an example and evaluate this particular policy. We are taking a term of 15 years, a lump sum premium of 10 lakhs, self-managed strategy, 100% in classic opportunities fund. That means 100% of the money is invested in a high risk, high rewarding investment option. Maximum money will be invested in equities in this fund. So high risk and high return investment option. According to Kotak Life's website, they have to assume 4% to 8% as the benefit illustration return. That means they assume that in a worst case scenario, the policy will deliver 4% gross return. In a best case scenario, they'll be able to deliver 8% gross return. So based on the best case scenario, 8% gross return, the policy will give you 12.59 lakhs. 12.59 lakhs definitely seems to be a very low return, right? So let us analyze the details. Let us understand and find out whether this seems to be a good return or not. Let us find out. So in a worst case scenario, at 4% gross return, this policy will appreciate to 12.59 lakhs. In a best case scenario of 8%, this policy will generate 23.47 lakhs. If you look at the actual internal rate of return, it works out to 1.55% and 5.85%. You may ask why, like it is giving you a gross return of 4% and 8%, Why the internal rate of return is shown us 1.5% and 5.8%, less than the gross return. This is where the charges which we have seen, right? There were 6 types of charges, right? For premium allocation charges, policy administration charges, fund management charges, this, that, all those charges reduces the overall net return to the policy holder. Because of that, though this policy is taking a risk and investing in stock market and generating adequate like risk premium return, the net return works out to 5.85% only, even in a best case scenario. So 5.85% is comparable to your bank fixed deposit return. And you may also know post office time deposit gives you slightly higher return than this 5.85% return. So do we have to invest in this particular policy? Let us take a couple of examples. We know what is the total benefit this policy is giving. Now we will take a couple of other investment options and compare this insurance cum investment policy returns with other investment options. Now, like I'm taking RBI bonds, Reserve Bank of India issues us bonds. I'm taking that and assuming like we are also taking a term insurance policy. So this is a combination, 10 lakhs, some portion is invested in term insurance, balance money is invested in RBI bonds. When you invest that way, how much return it works out? It works out to 6.02% after adjusting for term insurance premium. It works out to 6.02%. The maturity benefit is 27 lakhs here. Whereas in the insurance policy, in the best case scenario, even after taking a risk, it works out only to 23 lakhs. Risk-free product like RBI bonds can give you higher return by 4 lakhs. So 27 lakhs will be the net return if you are investing the same money in term insurance plus RBI bonds. Remember, RBI bond is government backed and assured return product. Right? It is not a private players product. It is not a like unassured product. Whatever the return given by this particular policy, this combination of term insurance plus RBI bonds is guaranteed. So that way, though RBI bonds are safe, they are outbeating the return of Kotak single invest policy. Now let us compare Kotak single invest with another risk premium product, which is mutual fund ELSS. Kotak single invest plan also invests in stock market. Mutual fund ELSS also invests in stock market. When we have a combination of term insurance plus ELSS mutual fund, that means out of the lump sum 10 lakhs, some money goes to term insurance premium, balance money is invested in mutual fund ELSS, then how much return it is giving us, right? If you look at the return works out to 53 lakhs. 53 lakhs definitely seems to be a very good return for investors, right? So if you look at it, it is giving you 11.07% IRR. 11.07% IRR is definitely a good risk premium return. This is not a risk-free return, it is a risk premium return because you are locking your money for long term, you are locking your money in a risk premium investment. So it is giving you an inflation beating IRR of 11.07%. It is definitely a good return for investors like you and me. So Kotak single invest, because it is giving you very mediocre returns, poor returns, I would strongly suggest you to avoid Kotak single invest advantage plan. However, you can take term insurance for getting life cover. If you are a very conservative investor, then you can go for a combination of term insurance plus RBI bonds. If you are someone who want to contribute regular premium, then in that case, term insurance plus PPF kind of combination can work for you. If you are an aggressive investor who is willing to take the market risk, then in that case, I would suggest you can go for term insurance plan plus ELSS mutual fund scheme. This way, you will be able to generate a risk premium return, inflation beating return. You will be able to generate. We have done an in-depth analysis of this particular policy. It is available below this video in the description box. It is available as a blog post. We have given you the link in the description box. Do you have any other questions related to this particular policy? Then feel free to book a free appointment with our certified financial planner with reference to this particular policy or any other investment options, achieving your financial goals. Related to all these things, you can book a free consultation with our certified financial planner. The appointment booking link is also given below this video in the description box. Would you like to attend insightful investment webinars where you discover very good workable investment strategies and techniques to create long-term wealth? Yes, we organize regular insightful investment webinars. It is completely complimentary. The free webinars registration link is also below this video. You can click the link and book your seat for the upcoming webinar. Hope you like this video. I'll meet you in the next video.